Hello, in this lecture we will define ratio analysis. According to Fundamental Accounting Principles, Wild 22nd edition, the definition of ratio analysis is determination of key relations between financial statement items as reflected in numerical measures. When we're considering ratio analysis, we're usually considering the measurement of numbers on the financial statements, meaning that the financial statement process, for the most part, has been completed in that we have the financial statements at this point in time, the balance sheet, the income statement, the statement of cash flows, the statement of equity, owner's equity, or stockholders' equity. We now want to look at that information and make decisions from that information. Whenever we're measuring performance, we're usually going to fall back on some format of ratio analysis. So whether we're measuring performance in terms of sports, if we're measuring performance in terms of how a baseball player is doing, we're going to have to use some ratio analysis to do that. If we're measuring performance on someone's job or someone's performance, almost any job or performance has some type of ratio analysis we're going to be using. We're going to use similar ratio analysis when we consider the performance of a company using the stats of the company, those stats being the financial statements. The reason we need the ratios, of course, will be that the static numbers, the static difference numbers, don't give us the information that we can readily compare to other companies or the industry average. For example, we can say that the dollar sales went up by a particular dollar amount last year compared to this year. That may have a lot of meaning to us, but it's really difficult to compare that dollar amount to the industry average or to other companies. However, if we create a ratio from it, that is something that we can then compare. And that's why ratios are so important when we're analyzing performance in just about any type of area. We could group the types of ratios into some broad categories to get a concept of what we're trying to measure. We could group the ratios that we may be putting together in terms of liquidity. We could group the ratios in terms of solvency ratios to help us determine the solvency of the company, or profitability ratios. So we might come up with different ratios to determine different things within the performance of the company. Some of the most common ratios: will the company be able to pay its current obligations with the current assets? That's often the most pressing types of decisions that we need to make, and those are often the ratios that will be looked at by banks and whatnot when looking for a loan as well. Will we be able to pay off our current obligations? We use things like the current ratio and the asset test ratio as some common ratios. And those would take basically the current assets, and we would see that on the balance sheet. We have a trial balance here. So the current assets, if we added up the cash, the accounts receivable, the allowance would be subtracted. And then the merchandise inventory, that would be the current assets of this 300,000. And then we can take a look at the quick assets. In this case, the quick assets would be more stringent than the current assets. In all cases, it would be more stringent. That means that we're not going to include the inventory. So we're including the cash, the accounts receivable, minus the allowance, and we're not including the merchandise inventory, of course, and we're not including the machinery in either of these calculations, because property, plant, and equipment cannot be used to pay the short-term obligations. That's the point. And then we're going to say current liabilities, in this case, are the 120,000. Those are the things that are due within a year. Then our ratio would be, in terms of the current ratio, would be the 300,000 divided by the current liabilities. And that means that if we have the 300,000 on top and the 120,000 on the bottom, that means that we can pay off the current liabilities of 120,000 2.5 times over with the current assets. So if the current assets, if we can convert it to cash and actually get 300,000 for it, and then we can pay off the current liabilities 2.5 times. If we want to be more stringent on that, we can say, let's just take the asset test ratio or the quick ratio. That's going to say, hey, I don't know what will happen if we can't sell the inventory. Then we're going to say the more liquid assets are 168,000. And if we divide that by the same current ratio, we're always going to get a smaller number, but we can still pay off the current liabilities 1.4 times, one time over and another 0.4 times over with just those assets. Now, an example of a common measurement that is not a ratio, but is just going to be a hard-coded number, is going to be the working capital. The working capital is just going to be the current assets minus the current liabilities. And the reason I put that in there is just to show that it's not going to be a ratio, and therefore that 180,000 has a lot of meaning to this particular company. But we can't really compare this type of calculation, a non-ratio calculation, to industry averages. If we're comparing one burger shop to a McDonald's corporation, we can't compare the working capital of 180,000 to basically McDonald's. It wouldn't make any sense. But we could have we might be able to get some relevant information if we compare ratios, like the current ratio and the asset test ratio, between a very small company and a very large company. That might give us something of value in terms of a comparison. That's why ratios are very, very important.